Hey, what's up, everybody? Welcome back to Investing Sucks. So today we're going to be doing an update video on a company that is definitely one of the more requested companies that you guys have been asking me about. And I think with the recent price action that we've seen happen on this company, I think now is a good time to do an update video on them, and that is AQN, Algonquin Power. Now, I'm sure if you're watching this video and you clicked on it on YouTube, you probably already know about the basics of this company and how they make money, what they do, etc. So I'm not really going to focus that, and I'm going to spend this video just talking about what has transpired in the past year for this company and what that means for them going forward. So in the past year, AQN stock is down about 43.27%. So it has gone down quite a lot. However, we are here just looking at the change in price, and we're not accounting for dividends that you would have received along the way, which is a key part of how you get compensated as a shareholder of AQN is through dividends. As we can see, their current dividend yield is 9.3%, which is quite high, which we'll talk about that a bit later. So what I want to do is look at what the price return would have been if we assume that you had received those dividends and then reinvested those dividends back into the company. So in order to do that, I'm going to use this script here, which, by the way, if you're wondering what website I'm using here, it's a website called tickernomics.com. It's a website that I created, which is designed to help retail investors get easier access to financial information, analytical tools. I'm going to showcase some of the features as I go throughout this video. But if you are interested in trying the website out for yourself, then I'll leave a link in the description and you can check it out. It's currently free to use. So I'm going to use this script here, which I created. It's called Dividend Reinvesting. And what this does is allows you to just enter a company, a holding period, and then a amount invested. And it goes back in time to determine what your return would have been throughout that holding period on that amount of money on that stock. So I have $10,000, a holding period of 1 year, to see what AQN did the past 1 year. And it assumes that you reinvested all of your dividends as soon as you received them, basically. So I'm going to click run on this, and it'll take a couple seconds, and then it'll give us the information we need. And the reason why I want to show this is to just show that the decline in price isn't actually that bad when you compare it to the overall market. So this line here tells us that the return in the past year is negative 35%, which compared to the S&P 500 overall and just the broader market, I think in the past year it's down about 30%. So this is still doing a little worse, and we're going to talk about why it's doing worse later, but it's really not that bad. I mean, the price kind of hides what your returns would have actually been just because they pay such high dividends. And we could even take this back a bit further. Like, let's say we do 5 years on $10,000 for AQN stock, and we can see what our compounded return would have been for those years. And so it's an annual return of 3%. So, I mean, not exactly great. But if we go back in time even further, let's say we go 9 years and see how the return would have been there. So again, we'll just run the exact same script, give it a few seconds here to load up. Now the return is looking a bit better, so it's about 13.5%, which is pretty strong. I'd say in the past 9 years, that probably has outperformed the S&P. So this is a pretty good stock. It has been in the past, but obviously there are some concerns with the future. So let's take a look at a couple charts here. So I'll go to the charts tab here, and one thing I like to do is kind of just gauge the overall sentiment with a company and see how that's changed over time. So I'm going to look at the price to sales ratio. I like the price to sales ratio because it tends to not fluctuate as much like a PE ratio for certain companies, because if companies kind of, skew in towards and out of profitability, then the PE ratio is going to be jumping around a lot. But a price to sales ratio is going to change, as the company grows. So it tells you a lot about investor sentiment towards a given company, because you can see, for example, here back in 2017, investor sentiment on AQN was much lower, and then it got a lot positive throughout to 2020, and it's since dropped a lot. If we drag and look at what it is now, I mean, it's currently 2.27, which is historically quite low. And then because AQN is a utilities company, they have regulated and unregulated utilities. We can also look at the price to book ratio. That's another good one to look at, and it kind of performs the same thing that we were just talking about with the price to sales ratio. So this one here, it's called price to book value, and we can see kind of a similar story. Recently, it has come down quite a lot, currently at 0.37%. So obviously, sentiment on this company has soured for whatever reason. Okay, so now let's talk about the actual reason why AQN has gone down so much. And the reason is, I think, a pretty simple one, which is that they have a lot of debt on their balance sheet. And with interest rates rising now, that debt is going to get much more costly going forward, which may mean less dividend growth going forward for AQN. And well, because they'll have less cash flow. And so investors that invest in them initially because of that potential dividend growth may now be selling because they're realizing it might not be there. And we can take a look at what the dividend has been historically going back with this chart here called dividend USD. And we can see if we go back 10 years, they've been raising their dividend fairly consistently. I mean, pretty much every year in lockstep, they're raising the dividend. So that's what probably enticed a lot of investors, especially people that would consider themselves dividend investors. And if they see there's a risk that this growth could stop, they're probably going to be selling. And I think interest rates are the key reason why. So, and if we look at the balance sheet as of their most recent quarterly filing, which was Q3 2022, we can see their long-term debt, the non-current portion of their long-term debt, 7.2 billion right here, and then the current portion is just under 500 million. And if we look at their assets, their property, plant, and equipment specifically, so this is going to be, what actually earns them money. It's just about $12 billion. So primarily they're financing their assets through the use of debt, although some of it is also through the use of equity. And if we were to take a look at their shares outstanding, we'd kind of see a similar story where they are continuing to have to increase their shares outstanding throughout the years, not as consistently, I mean, kind of intermittently, but the number of shares outstanding, as we can see, continues to grow because they do have a lot of assets they need to finance. And then also there's that debt, right? They've committed to, or that dividend rather, they've committed to, consistently increasing the dividend. People probably expect that from them at this point. So, and if they raise equity, that makes it very costly, right? Because if you have more shareholders and you're committed to raising your dividend, then not only do you have to pay more for the dividends to existing shareholders, but it compounds if you're adding more shareholders on top of that. So the dividend is getting much harder to finance, and I think that has some people concerned. And if we take a look at their 2021 annual report, they talk about interest rate risk and they call out this exact risk. So this isn't something that is unknown. It's not something that you would not have known about if you did your due diligence on this company. It's something that was a very real risk for them and very recognizable. And specifically, they talk about regulatory lag here, which is a time delay in the payment to the regulated service groups and also really, so the difference kind of between the costs that they incur, whether those costs are rising because interest rates are going up or just because of inflation overall, and the amount that they can actually charge in their regulated utility services group. Because as the name would indicate, regulated, the amount that they can charge is not determined by supply and demand or market dynamics. It's determined by what the regulators allow them to charge. So that's really the downside of investing in a company that's quote unquote safe, like AQN, is they're not perfectly safe because there is the risk that they may get some pushback from the regulators and not be able to increase the rates that they can charge as much as they'd like to, which could cut into their cash flow and therefore their dividend. But the plus side is their cash flow is pretty much guaranteed, right? Because all they really need to do is just build out their assets, and because they enjoy essentially monopoly positions once they have those assets hooked up and everything's running and they're connected to the endpoints that generate electricity, etc. Once that's all set up, it's not like the customers can switch to a different provider, right? Because then you'd have to do this whole construction project. So in order to account for that, the utilities do have to be regulated because of the natural monopoly positions. So there's a plus and there's a downside to this. And we can see now the downside is becoming much more prevalent, right? Because of the rise in interest costs, which if we take a look at the US federal funds rate, which their debt is going to be tied to this to some extent, you can see for a long time it's been pretty low. It kind of got high in this time here, but I mean we've had historic rate increases by both the Federal Reserve and the Bank of Canada, which is really causing concern for a company like this. Now, the one plus, I guess you could say, is that not all of their debt is subject to these interest rate changes that we're going to see. So it's not all variable interest rate debt. And they even talk about it here. They're saying as of September 30th, 2022, so fairly recently, 78% of debt outstanding in AQN and its subsidiaries is subject to fixed rate debt. So that's good because as we've seen, like interest rates have been low, historically low for quite some time. So they've been raising debt kind of in this area of the cycle and they've locked in those fixed rates, then they don't really have to worry as much about rising interest costs. However, not all of their debt is. Like they said, 78% is, but that means 22% is subject to variable interest rate debt. However, what you have to consider is not just the impact that their debt portfolio has because of current interest rates and as their current debt portfolio is, but what it's going to look like in the future, right? Because AQN is a company that is very much in growth mode. They're building out their assets, they're trying to expand, they're making acquisitions, pretty aggressive acquisitions. As you can see on the screen here, they're talking about Kentucky Power, which was an acquisition that they're hoping to close in early 2023. And they have to fund all those things that they want to do, right? And debt is traditionally what they've used. They did state in their recent earnings call they want to place less of a focus on raising equity, probably because it just makes their dividends so much harder to maintain and keep that dividend growth going, which is a big reason why people are invested in them. But with this acquisition of Kentucky Power, which is a transaction valued about $2.5 billion, they did state that a lot of the funding for that is going to come through their credit facilities, which do have a variable interest rate debt attached to it. So that's adding another just over $2 billion to the variable interest portfolio. So if interest rates continue to rise, 100 basis points into the future, and even if they go higher than that, it's really going to eat into their earnings, and it's going to make it hard for them to achieve the expected returns that they want when they invest in these new projects, because that's really how their decision making works, right? Because there's no risk that when they build out infrastructure that's not going to have some sort of payback for them, right? It's most of it's regulated utilities, and even the part that isn't regulated utilities, they have long-term power purchase agreements in place, which provides them pretty stable cash flow. So the real risk is that now the expected returns on those projects are going to be much lower because they're going to have to take so much more of the money that they would have earned and instead allocate it to interest. So it's significantly raising their cost of capital, right? And that's really something across all companies, right? All companies are having higher cost of capital. When the risk-free rate increases, it drags down valuations of companies, because now the way investors will make decisions is they're looking at the options they have out there, right? There's the risk-free rate, which now gives you just over 4%. Or if I want to take on more risk, how much am I being compensated for that risk? And you can look at, highly risky tech companies. You can look at less risky companies like utilities companies, perhaps similar to what AQN is doing. And now the investor mindset has shifted a little bit, where I'm not really as enticed by dividends, right? Or even dividend growth, because I can get 4% risk free. So because of that, and because of the effect it has on the interest cost, we're probably going to see AQN, or we have seen them fall, and it is going to weigh on their earnings for many quarters to come. So it may seem like I've painted a pretty grim picture for AQN, but what I want to talk about next is what they can do to mitigate these effects and kind of turn things around. So one thing that they can do to hedge themselves against future interest rate hikes is used interest rate swaps, which is a type of derivative that allows them to swap a variable rate of interest for a fixed one. So it doesn't necessarily lower their interest rate, but it just more ensures that they aren't going to get hurt by increasing interest rates into the future. And it's a pretty standard thing that companies do. It's really just a routine part of treasury management at any company. Any company that has a large debt balance probably does similar things. And then something else that they're going to start doing is what they announced in their most recent earnings call, which is their inaugural asset recycling program. So one of the key issues, as we talked about, is the rising interest rates and the interest expense, and then being able to find capital going forward to execute their growth strategy of building out these assets, having them come online and then earning cash flow for them, and then just continually doing that. So that could get slowed down because the capital they need to finance that expansion is now much more expensive. So one thing that they're going to start to do is the asset recycling program, where they sell off certain renewable assets that they have to help them fund that kind of expansion. And they didn't really give any concrete details on this in the earnings call. They really just said we're in the planning phases of it, and we're going to have more details in it in the investor day, which is happening early 2023. So we can really only speculate, but they did provide some details, as we can see on screen here. They did mention that about $400 million of renewable assets or stakes in renewable assets they're planning to sell off as a start. So that's really going to help them get some additional funding, which they do need funding to fund their expansion, the dividends we talked about, etc. So what I'm assuming the strategy is with this is Well, when they start a greenfield project, which is basically just a project where they have completely undeveloped land and they try and build something of value onto that land, they're essentially taking on all of the project risk by building out these renewable assets. And these renewable assets, they have the ability to earn cash flow once they're set up and the development phase is done. So what they can do is they can sell a partial stake in those assets to an external company. So the company basically generates value by using their development expertise to, I guess, crystallize some of that value by selling a stake rather than just holding on to 100% of the asset and then earning the cash flow throughout the life of the asset. It's kind of a way of just opening up some funding so they can use it for other sources. And the way they kind of create value in that kind of scenario is, like I said, by using their development expertise, which they do have a lot of as they're constantly, developing new things, having new projects come online, etc. But like I said, we're really going to have to wait for that investor day in 2023 to know the full details of this. And then one last thing they can do is going back to the topic of regulatory lag, which we talked about, which again is the difference between the fees that they're allowed to charge, that the regulators let them charge, and what their costs are, which there can be a mismatch between that or a lag between that, which can eat away at some of their margins. So what they're going to have to do is basically talk to their state regulators, provincial regulators, and basically ensure that they can raise their prices in order to be more profitable going forward. And it is highly likely that they are going to get some pushback from the regulators because basically increasing the prices of utilities is inflation, right? And inflation is such a hot topic right now. They're going to want to avoid having customers, or not customers, I guess, but more constituents deal with those increasing prices because that's obviously not what people want. And with inflation being such a hot topic, they're going to avoid as best they can. So what I think AQN here is a lesson in why you shouldn't get overly enticed by a high dividend or by a dividend growth stock. And also to understand the risks of investing in companies that have high debt balances in industries where they don't have the ability to increase the prices at their own will, right? Such as regulated utilities. And even looking outside of regulated utilities, in their renewable energy group, you can see this detail here, which I thought was interesting. Even their renewable energies assets, they earn revenue which is subject to long-term PPAs, power purchase agreements, most of which are not indexed to inflation and could experience declines in profitability if operating costs increase at a rate greater than the offtake price. So that's basically the same thing as regulatory lag, except they don't really have to talk to a regulator. It's more just the contracts that they set up with their renewable customers. So it's a really good lesson on why you need to understand a company in depth, and honestly just how reading the risk section about a company can be very telling. And I made a video about this a few months ago, basically looking at some companies that had gotten crushed recently and trying to determine if you would have realized or would have known about the reason why they got crushed just by reading the risk section. And what I concluded in that video was sometimes you can and sometimes you can't. Sometimes you have to use your foresight and your intuition as an investor. But honestly, reading the risk section, it really just gives you a good overview and it does capture a good amount of the risk that could happen. And, for AQN specifically, if you read it, you would have definitely foreseen this type of thing happening. Now, it would have really required some very strong foresight because, for example, if we go back even a year ago today, you know, QE was still happening, rates were still basically at zero, as we can see on screen here. So, there wasn't really the prospect of, this rampant inflation that we ended up seeing, which would have led to central banks taking action to raise interest rates to help curb that inflation. That wasn't really something that was top of mind for most people a year ago. So maybe if you were to read the risk section, then maybe you wouldn't perhaps have quite clued in on that, but it definitely would have been something that you would have known about once you would have seen all this talk happening about rate increases coming, because you would have been, as an AQN shareholder, you would understand how that could potentially hurt you. So anyways, guys, that pretty much does it for this video. So I hope you did find it useful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you'd consider subscribing. And I'll see you guys in the next video.